안녕하세요. 한국경제신문 워싱턴 특파원 이상은입니다. 오늘 저는 스텝스톤이라는 회사를 방문했는데요. 이 회사는 세컨더리 사모펀드를 주로 하는 회사입니다. 사실 여러분들에게 익숙한 이름은 아니실 텐데 기관 투자자들 사이에서는 꽤 이름이 알려진 굉장히 큰 규모의 자산을 운용하고 있는 회사입니다. 이 회사의 스콧 하트 CEO를 만날 건데요. 오늘 이분에게서 현재 투자 시장을 어떻게 보고 있는지, 앞으로의 투자 전략을 어떻게 계획하고 있는지에 대해서 한번 들어보도록 하겠습니다.
Could you introduce yourself a little bit to our readers?
My name is Scott Hart. I'm the CEO and head of private equity at Stepstonegroup. Stepstone is a leading global private markets investment firm that operates all parts of the private markets, including private equity and venture capital, real estate, infrastructure, and private credit. We were founded in 2007. I've been with the firm since the very beginning.
And Stepstone is a public company, right?
That's correct. We completed our IPO in 2020.
Stepstone Group's stock price has been doubled this year. So what is the secret about behind?
I'm not sure there's any great secret. I mean, I think we do have the benefit of operating in and really specializing in a market that is growing and is attractive. We, over the years, have built a platform that is well diversified across a variety of different metrics, whether that is the 4 asset classes I just mentioned, whether that's across different strategies, different geographies around the world. I think that diversification has really helped us to weather any storms in the sense that there's always a part of our business, whether it's an asset class or a specific strategy, that is very much in demand. And I think when you look over the last year or two, it ultimately comes down to strong execution, despite it being a somewhat difficult market. And one of the ways that we often described this was that we felt like we were really laying the groundwork that was going to set us up for growth in the coming quarters and years.
The private investment market is growing overall, I think. And what do you think are the reasons for this kind of a growth?
Sure. I think there's a number of things that are driving the continued growth in the private markets. One is the returns, the potential to generate strong risk-adjusted returns, particularly relative to the public markets. And two is really the diversification benefits of incorporating private markets investments into one's portfolio. I think these have really been two of the key drivers that have resulted in many institutions and now individual investors allocating larger percentage of their portfolio to the private markets. I think there are a number of other potential drivers. We certainly at Stepstone have a belief in the benefits of a control-oriented investment strategy, which is really what the private markets lend themselves to.
What does it mean, control-oriented?
A control-oriented meaning because, for example, a private equity firm is not just making an investment in a company, but acquiring the entirety of a company. They can make certain decisions or changes because of the control they have that would not be possible, for example, in the public markets. And I think that control orientation is one of the things that has helped drive the strong risk-adjusted returns over time. And really the last point I was going to make is that there are certain parts of the market that are no longer accessible purely by investing through the public markets. The only way to invest in areas like early stage venture capital or in certain parts of, say, the infrastructure market may be through the private markets as opposed to the public market. So this has all led to a trend over time where we've seen many investors increasing the percentage of their portfolio that's being allocated to the private markets.
What is the strong point to have those kind of a strategy? And I think there will be also some downside risks.
It's not so much that I would highlight risks, but a number of challenges associated with trying to access the private markets. Because there's a number of factors that one needs to take into account when thinking about how to build a private markets portfolio. Many of the investors that we work with tend to have relatively small teams of individuals that are covering the private markets, but the private markets over time have become increasingly global. They become increasingly complex, and so it's challenging to cover the entirety of the universe. It may be difficult to access the right managers or the right investment opportunities that you'd like to invest in. There's an information gap. So unlike the public markets where data and information tends to be available to anyone who wants it, in the private markets, data and information is really only available to those who are actively participating in the private markets, as Stepstone is. So there are a number of different challenges that an investor faces. They then need to think about how to operate, how to access the private markets successfully. the final one I would point to, and you could consider this a risk, is the potential illiquidity of the asset class. And so you need to go into this understanding it's a very long-term asset class. You're making commitments that are going to be drawn over the next 3 to 5 years and realized over the following 5 years after that. And so it is a very long-term and somewhat illiquid asset class, although there are tools or markets like the secondaries market that have developed over time to help address that. If you compare what we do today to what a limited partner in the private markets would have done 20 or 25 years ago, is a much more data-driven analytical process today, helped by some of the data and technology tools that we have developed over time.
How do you assess the overall mood of the investment market recently, and have there been any kind of significant changes in your investment strategy?
I'd say the overall mood of the investment environment has certainly improved somewhat throughout the course of this year. I think as we turned the corner into 2024, many of our clients were now starting to be prepared to increase their level of activity, whether that was making new commitments, whether it was getting back to trying to identify new managers. And so I think after a slow couple of years from both a fundraising and from a new investment standpoint, I think we saw the mood start to shift in the early parts of this year. We saw activity levels bottom out probably sometime in 2023 and start to recover, even though we're nowhere near back to long-term averages today. In terms of whether we've had any strategy shift, I would say not really. Again, we've developed a platform that is comprehensive, all-weather exactly, whereas we had a very active several years on the secondary front. So our secondary investing strategy really across asset classes has probably been one of the most active areas for us. We have definitely seen deal flow and activity levels come back in other parts of our business, for example, in our co-investment business, where not only the number of investment opportunities that we are seeing, but the quality of those opportunities has improved in recent quarters and has resulted in an uptick in the amount of activity in that part of our business as well. But it's no major change in strategy for us. It's just different parts of the business that tend to be active at different times.
But hasn't there been any kind of changes about the ratio of these specialized assets like alternative investment? Has it been increased? The ratio of the alternative investment, alternative assets?
No, I think certainly for individual clients that has been the case over the years. Now, StepStone, which specializes in private markets or alternative investments, that continues to be the sole focus in the area that we specialize. I think what you've seen in limited partner portfolios is they have found themselves, at least temporarily, over-allocated relative to their targets, relative to where they'd like to be in terms of their allocation to private markets. But what you've not seen anyone doing is lowering their long-term target allocation to the asset class. If anything, long-term target allocations continue to be stable, if not growing over time, as the continued interest in the private markets for the long term is there. Maybe that is shifting, and maybe there's outsized growth in specific asset classes. Private credit and infrastructure have probably been two of the asset classes that have benefited from strong growth in recent years. And there's probably a slight shift in different strategies. Again, the secondaries market has been growing quite rapidly with the evolution of new types of strategies like GP-led secondaries, which is really a new phenomenon over the last several years here.
Could you elaborate a little bit about this GP-led secondary investment strategy?
Sure. I think whereas we have historically probably thought about the secondary market as groups like StepStone or other secondary investors buying out LP interests from limited partners who want to exit their stake in a fund. More recently, we've seen a trend towards GPs selling companies into continuation vehicles, either a single asset or a multi-asset portfolio, where they will look to the secondaries market to help them price and ultimately acquire those assets while providing a potential source of liquidity to their existing investors. And so that is a trend that has grown very rapidly in recent years. Those GP-led secondaries tend to focus on and target some of the higher quality assets within a portfolio. And during a period of time where we've seen a decrease in the level of distribution or realization activity, continuation funds and GP-led secondaries have proven to be an attractive potential source of liquidity for investors.
when I met the KIC person here, and then he mentioned the denomination effect. Is it the same one as you said it?
So the denominator effect is one of the things that contributed to the comment I made about LPs being temporarily over-allocated to the private markets. And so what we mean by that is, let's say an institution has a target allocation to have 15% of their portfolio in the private markets, and the public markets experience a decline, which shrinks the size of their overall portfolio. Well, now their private markets portfolio may no longer represent 15%, it may represent 20% of their portfolio. So now they find themselves over-allocated relative to their target, driven by the denominator shrinking. That has largely been alleviated at this point, right? Because we've seen the public markets rebound quite strongly over the last year or so. And so the denominator effect is no longer the key thing that's driving this over-allocation. We at StepStone have actually been referring to it now as the numerator effect, because what you had seen in the lead up to this period was a period of rapid investment, which probably grew or inflated the numerator. And now we've seen a significant slowdown in the amount of distributions, which would normally have the effect of shrinking the numerator. And so now you have this scenario where the over-allocation is less driven by the denominator, more driven by the numerator. That is one thing that has contributed to secondaries activity as LPs have looked to bring their allocation back down towards their targets. The other thing that has contributed to the secondaries activity is this slowdown in distribution. So if an LP needs to generate liquidity across their portfolio, they can either sell interest in the secondary market, or if GPs complete a GP-led secondary, that may be a source of liquidity for them as well. So these are all interconnected trends here.
There could be some kind of a market sentiment from risk on to risk off, and sometimes be the other vice versa. What do you think? Is this a time we need to focus on risk on strategy or risk off strategy?
I think this idea of risk on versus risk off strategies in such a long-term asset class like the private markets is very difficult. It is difficult, if not impossible, to time the markets in the private markets. Again, you've got to think about the fact that we are committing capital that's then going to be invested over several years and then realized over several years beyond that. It's hard to be risk on or risk off. The approach that we really encourage our clients to take is more of a stable commitment pace over time. You think about it as sort of dollar cost averaging, but you're making sure that you've got exposure to and diversification across vintage years. And we think that is the best approach to the private markets. Trying to time it is really a difficult thing to do.
I think time is your friend, actually, not the adversary or something.
Correct. And we, look, in parts of our business, by committing capital to strong, disciplined managers, we are relying to some extent on their ability to not only identify specific opportunities, but determine when it's the right time to lean in and lean out. But again, I think for the typical limited partner, very difficult to time the private markets.
What are your expectations at the scale of the Federal Reserve's potential interest rate cut? Do you have any idea about that?
Look, I think one of the things we try to do a good job of is knowing what we know and also understanding what we don't know. And so we spend a lot more time planning for different scenarios as opposed to trying to pinpoint exactly what's going to happen. I mean, if we do experience a smaller rate cut or series of rate cuts than one might have otherwise expected, well, maybe part of that is because global growth or U.S. growth is holding up better than expected. And so there will be trade-offs in your portfolio. Yes, we've got higher interest expense and maybe there's some pressure on valuation multiples, but part of that is because we're experiencing higher growth than we otherwise might have expected. So I think certainly part of what contributed to my comments earlier around as we entered 2024 and saw investors more willing to transact, it was having a sense that interest rates had peaked, and although we didn't know exactly when or exactly how big the rate cuts would be, that we knew which direction they were heading. And I think that's a little bit how we feel today.
Do you have any kind of recession scenario in your mind?
We are always running recession scenarios. I don't necessarily have a specific scenario in my mind, but if I think about where we spend a lot of our time when we are underwriting new investments, specifically in individual companies, it is understanding the downside, understanding what a true recession might look like. And I think the mistake that we've, as an industry, sometimes made in the past is the recession cases that are run are really conservative growth cases. And I think the benefit coming out of the financial crisis was that all of a sudden we had this true recession case. And every new investment that we or others in the industry would underwrite would look at the GFC case and understanding, can this company withstand a similar decline to what we experienced in the GFC? But as that becomes 10 years removed, all of a sudden the recession scenarios are less and less dramatic. And so we as investors here at StepStone try to spend a lot of time understanding the downside, understanding what it would take to lose money on investment. We often make the comment the best way to make money in the private markets is to start by not losing money. And so you would hear, if you talk to each of our different asset class heads or the individual team members across different strategies, there's always a lot of focus on downside protection, asymmetry of returns to the upside.
If the downside comes, if there is a crisis comes like something like the GFC, and then how would you react?
I mean, the closest thing we've had to it in recent years was the downturn during COVID, right? And so the way that we and others reacted was to want to gather as much information on the performance of our portfolio companies so that we could be well suited to make additional decisions about whether to support portfolio companies or what we might need to do in that scenario. Ultimately leads to a tremendous amount of communication with our GPs and with our management teams. One of the most positive developments that we saw during COVID relative to the GFC was that level of transparency and communication and information sharing across the GP community. I think the private markets asset classes have come a long way in that sense towards more transparency, more information sharing with investors, and we were the beneficiaries of that during COVID.
We've heard about your recent venture capital secondary fund, and could you please share your insight on the current liquidity situation of the VC market compared to before?
So in venture capital secondaries, we currently have the largest secondaries fund in the market. Clearly the venture market had experienced tremendous growth up until 2021 and the first half of 2022. But with the interest rate rises that we talked about, that led to a pretty dramatic slowdown in deal activity. It led to a pretty significant reduction in sort of valuation multiples, both in the public markets and in the venture market. And so for some investors that were heavily exposed to venture capital, you found them looking to do the same things that we talked about earlier, trying to bring their allocation down or trying to generate liquidity at a time when liquidity was tough to come by. The benefit that, and some of this takes time to play out. I think initially the discounts that would have been required to transact in the venture capital secondaries market were so significant that most LPs were unwilling to transact. As valuation multiples came down over time, over several quarters, it got to the point where discounts were now at an acceptable level where you did see an increase in the level of transaction activity. And the benefit in venture capital was this came after a very significant and very strong performance over many years. And so even if you were selling at a discount, you were locking in strong gains that had been generated over a long period of time in venture capital. And I think that, at least psychologically, helped buyers and sellers to get to a point where they could transact. I guess the only thing I would say is we don't think the secondaries opportunity is limited to just venture capital. I think there are similar opportunities that exist in real estate, growing opportunity on the secondary side in both private credit and infrastructure. And so, secondary is a big part of our business across all of our asset classes today.
Do you expect more competitors are coming to the market as well?
The secondaries market is certainly an active part of the market where there are, competitors, particularly in private equity secondaries. There's probably a smaller number of competitors in areas like venture capital or infrastructure and private credit, or in the parts of the real estate market that we play.
When I understood Stepstone Group, I thought you are mainly focused on the institutional investors, but nowadays it seems you are now gaining popularity among individual investors as well. So we've heard that your success in the private wealth market, and would you mind elaborating a little bit on the rationale behind the strategy to have more individual investors?
When you think about the StepStone mission is to be the trusted partner of choice for private market solutions globally. And that is to all potential investors in the private markets, institutional and individual. Certainly to date, the institutional part of our business has been the largest part. But one of the things that we and others certainly saw several years ago was that the individual investor represented probably one of the largest, fastest growing, and most underallocated parts of the private markets. And so certainly saw an opportunity there, but also recognized that there are a number of challenges associated with the individual investor getting access to private markets. Individual investor typically does not want to deal with capital calls. There are tax reporting complications. In the U.S., they don't want to receive a K-1. They'd rather receive a 1099 tax form. Understand these challenges and then think about the type of product that we would be well positioned to create to meet the needs of the individual investor. And look, that was a process that took some time. We launched that business at a difficult time, just as we headed into COVID. But roughly 4 years later, have just hit some big milestones, having reached about $5 billion of AUM in our private wealth business, and have now rolled out a suite of different products that not only get you access to the broader private markets, but some more specialized strategies like venture capital and growth equity, infrastructure, or private credit. So an individual investor decides they want to subscribe to your fund, and you then look to invest that money more or less right away. That is a different process, and it requires a very active pipeline.
And looking ahead, how do you balance the ratio between institutional investors and individual investors in your portfolio?
I think you use the right word. It is a balance. And I think that's not true just in terms of individual versus institutional. I think is a question that we've often had to focus on, even when the business was entirely focused on institutional investors, which is you do need to maintain balance in your business. For example, one of the areas that we need to maintain balance is between primary fund investment business and the co-investment and secondary business, in terms of how much capital is being committed and how many GP relationships do you have that can then be used to source or to generate the information advantage that we utilize when investing in co-investments and secondaries. So there's no prescribed percentage or ratio, but I think you put it right. You have to think about the balance and how that develops over time across your business.
What if I'm a neighbor to you, and then we met in the swimming pool, we are having a chat. If I would like to ask looking for advice, my personal investment portfolio, and then what would you say?
Again, an individual investor looking for private markets exposure, again, I think we've developed a number of very interesting products that would help you achieve that in a way that alleviates or addresses many of the typical challenges for an individual investor investing in the private markets. And so, as opposed to an individual stock or an individual sector, I'd probably lean towards the more diversified approach.
Are there any particular areas of Korean assets you're interested in?
I don't know that I would identify any specific areas or industries, right? I mean, if you think about our approach in any market where we operate, it oftentimes starts with having strong relationships with local managers in those markets. And so we have had good success investing in Korea through some of our local partners, either into their funds directly or into specific portfolio companies on more of a co-investment basis. And particularly right now, at a time when many of our investors and our team is kind of looking at Asia and thinking about how they ought to be allocating across different Asia geographies, really driven by the fact that China probably representing a smaller percentage of many clients' portfolios. It has led to a lot of time focused on Korea, Japan, India, Southeast Asia.
Are you trying to reduce the exposure to China?
Overall, you've certainly seen a reduction in fundraising in China and appetite for China investments, whether driven by slowdown in growth or geopolitical concerns or regulatory changes. I think the conversation that many clients have had is, okay, I'm still very much interested in sort of the Asia growth opportunity. There's more to Asia than just China.
I think since you're doing some kind of, you're doing great on the overall all-weather investment strategy, and which means balance is everything, right? And in that case, I think AI could help to find the balancing spot, and it would help you find the right time or right place to invest right now. Do you think this kind of AI technology will be used more and more afterwards?
Absolutely think that's going to be used more and more. We and many others is trying to fine-tune or identify the most effective ways to use it today.
Using those kind of artificial intelligence to find the right spot and right place to invest. And then I imagine there will be quite similar portfolios within among the investors. Do you think so?
Again, it's probably part of the reason that I make the comment about having truly differentiated data and information. And if that's part of what is feeding your AI tools, that may result in differentiated viewpoints than those that are operating based on information that's available to all investors.
But I imagine it might conclude as a less alpha in the market.
I think the other thing to keep in mind is that the core behind StepStone's story, StepStone's creation, right, was the understanding that no two investors are exactly alike. And the needs of any two investors or two investor types may be very different. And so, again, understanding that for a given investor, a larger allocation to private markets, a different allocation, different geographies, different liquidity needs and cash flow requirements are always going to result in investors building or attempting to build different portfolios that are specifically designed to meet their needs. And again, that is really when I think about some of the key observations that we made when StepStone was founded. It was that understanding and that recognition that no two investors are alike, and that there's an opportunity for us to serve them with very bespoke, very customized approach, and I think has been well recognized and part of what has driven our success over time.
Thank you so much.
Thank you.